I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, now part of Sapiens, enabling enterprise-scale underwriting through a single pane of glass. Patrick Tiernan has come into the CEO role at Lloyd's with the market brimming with confidence after a third successive year of strong profitability. Now that competitive forces are reasserting themselves with renewed vigour, the question is, what next? From this meeting, the future at Lloyd's is one full of increased velocity and innovation in all things. New leadership, new forms of underwriting, new targets and ambition, new risks, new ways to transact business, new skills and attitudes from the people who work in the market, and new capital structures to bear the financial load. Recorded live in the centre of the underwriting room by the Rostrum on a busy working day, this is an energetic encounter from start to finish. If you want to get a clear feel for the charismatic new Lloyd's CEO's strategy and modus operandi, this will get you up to speed in no time. Patrick is easy to talk to and is disarmingly frank. From my experiences of doorstopping him whenever I've had the chance over the past 5 years, I can promise you that we would have had the same conversation whether or not the microphones had been turned on. What you see is what you get. So listen on for an audio roadmap for the market of the next 5 years and beyond. Enjoy the podcast. Patrick, welcome back to the Voice of Insurance.
Thank you, Mark. Great to see you again.
Well, it's really nice to do something different. I've done one podcast walking the streets of EC3, but I've never done one here right in the middle of Lloyd's, right in the middle of the atrium, right in front of the Lutein Bell. So thanks for letting me do that. I thought for a minute we were a trip hazard here for some of the visiting groups.
Well, isn't it great? Because so often we're hearing that people aren't coming back to offices, people are working from home, the same buzz isn't here. Well, hopefully the background noise today will tell people, I think we're in a pretty buzzy underwriting room today.
No, for me, I'm getting the kind of Monte Carlo vibe that, when I'm sitting at the Café de Paris, and of course there are waiters here too, but they're generally not serving or sort of smashing plates down in the way that they do in Monte Carlo, but I'm getting that feeling. And also, it does belie, actually, I was with someone the other day who said, the underwriting room is quite empty, and it's completely untrue. It's a Thursday. Okay, maybe Tuesday, Wednesday, Thursday busier than other days, but it's just as I remember it when I was a broker. It's no different.
It's got the buzz. I mean, I'm here 5 days a week, and it is quieter on Mondays and Fridays, but it was always quiet on Fridays.
Friday afternoon, absolutely.
Yeah, it's quieter in the early morning and the late afternoon. There's the peak periods here. That was the same pre-COVID, but it does have this buzz. And if you just sort of look at the average age and the mix of gender and ethnicity here, it's a bubbling marketplace. It's what we talk about wanting, so we should celebrate when we have it. And if I can pick you up on something, the big difference between here in Monte Carlo is it's £3 for a coffee downstairs rather than 12 or 15 euros. So we're great value when it comes to...
Well, I suppose, London has got expensive hotels as well. If we did all our conferences in the Ritz, we'd also be paying £12 for a cup of coffee, I'm sure.
But you'd have less great ambience and less great architecture and atriums hanging over you. So,
well, yes, I think we could talk on this tone all day, but I suppose we've got to get you to do some hard work, Patrick.
Business, yes.
Congratulations. Fantastic set of annual results. Again, now 3 in a row, hat-trick. Obviously, not all down to you.
No, we're very clear on that. We tried to make sure that shift was there, Mark, when we were talking about the results on March 19th. We're reporting the results of the market. We're very, very proud that the market performed so well. But they are the market's results. And then as we look forward into 2026 and 27, it's the market's responsibility and our guidance as we work with them to maintain that result and maintain the hard-won adequacy over those last 3 years.
Well, the other big headline was your strategy. You're the new man in the job. You've been doing the job for quite a while, but this is your own stamp, as CEO of Lloyd's. Can you run us through that strategy, the main points for anyone who wasn't paying attention?
Yeah, I think at the core of the strategy is a sharpening of the financial edge of the corporation and the market. So we're being very clear that what we're here to do is to enable the returns of the market to be greater under our stewardship. And that is, I think, a little bit of a break from the past. We're being very, very clear on that. And actually, it's been welcomed in terms of that clarity of purpose in the 3 places that was really critical for me. The investors, the global investors who actually bring their businesses here, the people who actually ply their trade in the market, the people who work in the managing agencies, the syndicates, the brokers in London, but also very critically for us, the people who work, the 1,200 of us who work in the corporation itself, that we have now clear alignment of purpose and of strategy with the market that we serve. So it was really important to get those 3 groups together. And in terms of your question about, well, what is the strategy? What's the what in there? We built it around 4 clear drivers. Performance, to make sure that leading underwriting performance has continued to be a market that had underwriting at its core. And we lead in every way. Lead in results, lead in line size, lead in new risks. So all very important. That you'd expect from me. Number 2 was efficiency. And we talked about it in terms of friction, so both speed and cost, so we can be competitive with the other options that people have in terms of applying their trade. Number 3 was one where we sort of pushed the boat out pretty hard, which was on capital efficiency. Lloyd's has an array of strengths, but it has one unique advantage, and that is its capital efficiency. Yeah. So we talked about that pretty hard. And the last thing, I think, and again, I think it was pretty new, was we put a Lloyd's to be proud of at the centre, because that's what brings us all together. No matter what area of the market you're in, you feel that association and that pride. We all want Lloyd's to be successful, whether we're working in the corporation, working in the broking houses, or working in the underwriting shops or investors around here.
And say specifically on the numbers of that performance side, it's a sub 95% combined ratio over the cycle and a 12% return on capital over the cycle. Could you have gone a bit harder? Do you think you could have been stretched more?
No, I think we have to find the right balance between what's achievable over a 10-year cycle, what is in our jurisdiction as a market rather than as a profit optimizer, because that's not our job, but also being thoughtful about what's happened in the past. I mean, I think if you understand what the 10-year average performance is on across all those metrics, we're not hitting them. So when we look at the key one, which is the 12% return on capital, well, 3 years ago it was 3.8%. It's up to 9.6% now, but we're not there. So we've got to keep that performance going, and we've got to be able to maintain that average through those difficult years when we may have very strong wind, where we may have earthquakes, where we may have very difficult conditions.
There's no get-outs there.
There's no get-outs.
It doesn't include CAT.
Or it doesn't include COVID, or it doesn't include this. It is all in. It is what ends up in the investor's pocket. It is how we ensure that this market has a longevity of investability for the folks who are around here. And I think as well, if I may, the reason why it was important for us to have ambitious targets is because I took over as CEO in a slightly different atmosphere than those who came before me. It was from a position of strength. The market has been performing pretty well. I have worked here for 4 years already, so I'm familiar with both the corporation and the market. So I think that's why we have a raising of the bar. That's why we have a higher level ambition. But it's also why we're going to hold ourselves to account. Very often we talk about what we're going to do. We've actually put measurable metrics in there across all of those dynamics. So sub 95% on the combined ratio. That means we have to be an underwriting market, and we've got to hit it. The 1% proximity in terms of cost. That means we've got to keep our costs competitive with non-Lloyd's businesses both here and abroad. The 12% return on capital, that is assuming that without all of the gearing that could go in. So members, institutional investors, corporations, or our traditional individual names, they can boost that by taking more risk or putting a different capital stack in there. And then we've committed to, from a corporation perspective, excellent culture, excellent service through that NPS, but also a cost-income ratio. And hopefully we'll come back to that in a bit, because that really is important, that 80% cost-income ratio, that if we produce a surplus, we'll think of what we can do in the future in terms of investing that surplus.
So explain exactly what you mean by that.
It becomes a more investable place. People want to bring new business here or existing business elsewhere. They want to bring it into Lloyd's for that capital efficiency. So if we can continue to throw off a 20% surplus, that gives the council, so it won't be my decision, but the executive of Lloyd's will bring it to the council and say, well, here's what we can do with this. And one of the thoughts I have already is that if you've got a great advantage, which we do on the capital side, we've got a inarguable 33% capital advantage on other jurisdictions to get to AA, you can extend that. So you can invest the surplus in extending that capital advantage, maybe making it 40%, or maybe increasing the strength of the balance sheet. And that, I think, is going to be something that you're going to see us talk about a lot more over the coming years.
We could talk about ratings because, of course, I mean, the rating is the ultimate de facto regulator, isn't it? You don't want to be BBB+ because it means you can't do the same business as when you were an A-. And so, I mean, that round the period of decile 10, that was the ultimate sanction. It was the ultimate reason why this had to happen, because we could get downgraded, and we don't want that as a market, do we? I look at it, it's almost like a ratchet. if you get an upgrade, do you see that as a ratchet? We can never get downgraded.
Yes. So it is a double-edged sword, as you say.
Because no one ever wants to read, on the front page of a newspaper, Lloyd's of London downgraded. It would just be horrendous.
And also for the businesses that are trading here, you see some of the new lines that are coming, they're here because we're double A. So it's really important that we maintain it.
So within credit, obviously, it's the price of entry in the game, isn't it?
Yes. But I think also the size of client and the line size that can be deployed, I think it's easier sell for the broker to their client if they've got the double A backing there. So I think for us, from a capital perspective, that means three things. Number one, we've got to adopt that fortress balance sheet that we hear institutions like JP Morgan or Berkshire talk about. We've got to make sure we protect what we have. Number two, we've got to democratize the deployment of that advantage. Make sure everybody knows how to access the capital advantage that is there, which is particularly the case for third-party capital. We're seeing those on some of the reinsurance vehicles and some of the portfolio solutions. But the exciting thing is to go beyond. What else can we do? And I've talked about it in smaller audiences before, and that is to actually be a market for structured solutions, to marry third-party capital with the insurance capital that's there, to think about the big solutions that are needed, be they in areas like defense or energy or infrastructure. The buzzword of the day is in data centers, but I think there are other places where insurance, and particularly insurance in Lloyd's, can be part of the financing package in a way that actually brings down the cost of capital.
Yes.
And therefore the IRR becomes investable because of what you do here, and that would be pretty cool.
So on the rating, because it's a ratchet, effectively almost like a sort of moral ratchet, you wouldn't go for an upgrade unless you wanted that forever. You wanted that to be a permanent new plateau at which you're sitting.
Yes. The way I think about it going forward is the capital management strategy needs to marry with the ambition of the market for the strength of the capital that's here. So I wouldn't class it as what's the next upgrade or what's the next important step. I think we do the right thing, and then the rating agencies make their decisions. We ensure we protect performance, which is a critical part of keeping the rating. So that's why we got the sub 95% combined. And then you have that fortress balance sheet that gives confidence in the rating that's there. And I think, as you know, and as all of the listeners of the podcast know, there tends to be a time of seasoning, of embedding a rating upgrade. So Burkhart got the upgrade for us 18 months, 2 years ago. So I think we season that in, and then maybe under my leadership there's a time for upwards review, but let's keep it for now.
You always want to be on the positive outlook rather than, under review.
Ain't that the truth?
Well, you've mentioned about some of the novel ways that the platform are being used. And obviously, just from a basic economics point of view, of course, that has to be good for everybody because it reduces the cost of capital, or it reduces the expense ratio, or whatever. It reduces the cost of doing business in the platform. But how vigilant are you? Obviously, it's been really interesting seeing, for example, reinsurance vehicles being used at Lloyd's and net credit and now potentially structured solutions. But how vigilant are you and how protective are you of the platform in that sense? Because, of course, it's a worry if we get into things that we don't understand and we end up being used as a sort of laundromat for everybody else.
So the answer is we are extremely protective. So performance is number one. It's the first thing we think about, and it is our credibility to make sure that Lloyd's is performing ahead of the peer group. And actually, I think you and I have talked about this privately before, but we have in VJ Dowling, they have a basket. They've created a peer group for us of 27 major insurers and reinsurers that are our peers, stripped out all of the lines of business we don't write, and we actually benchmark ourselves. We would like the market to be performing ahead of that peer group. We think that's really important for the credibility of the market. So when I think about the future and how protective we're going to be, why does that work in practice? Number one, it is about having the conditions that the best underwriters want to ply their trade here, because there's nothing better than a self-regulating underwriting market. That's the most powerful. Number two, I think we've got to be very cautious in business that is potentially commoditizable, that does go up and down with the cycle. And I think we have been very impressed. Rachel and myself are very impressed. I would say the majority of the market has pulled back from the ambition that's in their plans as they've seen the rating environment not be what they expected it to be. But the opportunity, and I've talked about this quite a bit over the last 6 months, is to be able to walk and chew gum, to be able to look at new risks with ambition while making sure you've got discipline in the core risk. So where there are nascent risks in those areas, where the real dollars are being spent in the economy, and there's low penetration in insurance. That actually allows us as an underwriter and as a broker looking for the client, two things are very important. In the short tail areas, you've got pricing, terms and condition, and repricing power. Very important, because that allows you to take new risk, take nascent risk with a bit of confidence that you can learn as you go. Number two, this is particularly as I speak to global brokers, both here or when we're in New York or in Florida, wherever they're located. It's not that exciting for CEOs of brokers to know the business is trading that was outside of Lloyd's is going inside of Lloyd's. It's not really hugely exciting for them because it's not growing their total income, their total pie. They want to be making new markets for their businesses. And I think that is quite exciting, that Lloyd's can have and maintain that reputation for being a market of firsts. For actually being able to say, we don't have all the data, we don't have all of the answers, but we think that as a market, using the syndication, using the consortium structures, we can go at this point.
You can be the crucible, the sort of petri dish where we find out what these things are, and then hopefully if they're no good, then we stop doing them pretty quick, but if they're really good, they become the next cyber or the next D&O, whatever.
Well, yes, but I think, again, so talked about this a bit within our own teams, challenging ourselves. What is the next cyber? What is the next market? The cyber market, well, we're very proud that it grew in Lloyd's, and we're still, 20-25% of it. It grew from 1999 when the first cyber policy was written to now where we're at 15, 20 billion globally. The speed and the scale of the investment in data centers, energy, infrastructure, we don't have 20 years to figure this out. So what we're challenging ourselves with, how can we meet the challenge of the speed and the scale that innovation is happening in the real world with what the offering can be from this market? And that requires the corporation, that requires all of us who work here to actually be a bit more thoughtful about what risk are we actually trying to manage.
And how's it going with the ICX and TCX? I haven't really had an update on it for a while. Is it being taken up?
ICX and TCX growth at the rate it's happening won't be exciting for the next 5 years. So that's why all of the exec team, we've basically said, what do we need to do differently? We need to allow the market, not individual firms per se, but the market to find the scale quicker. And rather than therefore make line size and make reinsurance outside of the market a function of GWP or a function of what you do in Lloyd's, we use the fact that we now have principle-based oversight. If you've got the capability and if you've got the expertise within your shop and you can bring it to Lloyd's if you're a global player, or if it's all in Lloyd's if you're a Lloyd's only player, well then we can have the confidence to move quicker with you. And so we're actually encouraging the syndicates and the managing agents to engage with us on the ambition that they have, such that we can meet them where they want to go rather than they have to build a little bit in Lloyd's and a little bit outside of Lloyd's.
Right. I was at a Lloyd's lab, the pitch day, really interesting because one of the themes was AI, and this is AI as a peril in itself. And in fact, some of the people there was almost ensuring the efficacy of AI, which is very sort of not generally an insurance territory that we often want to go to because it's probably too close to enterprise risk. But what's your view generally on AI as an emerging casualty peril? Obviously, it's in there, it's silent. We've been here before with cyber, obviously, and some of these cyber war things.
I think from my perspective, I try and look at how AI is being deployed either in manufacturing or service delivery in the real world, and then sort of go, how is that going to impact the risk characteristics of classes of business that we're more familiar with already? So if we take the two extremes, in life sciences, as AI is used in bioinformatics and is used in the models to actually test procedures, treatments, etc., there's less humans involved in there. So therefore, the casualty risk is decreasing, and therefore it's likely that that is an area where we have less to worry about in terms of the longer tail and the potential serious injury to folks. So therefore it might not be an area that grows as quickly in terms of the available premium. But then more topically, in the theatre of conflict and of war, and you have AI being deployed potentially instead of human decision making, well then the potential for escalation and at speed becomes greater. And then some of the mechanisms that we've used in contracts, periods of cancellation, etc., in order to catch up with how the risk is escalating, they may not be fit for purpose in years to come. And therefore we have to ensure that we're following the potential for risk changes.
Do you think there a potential for one of those difficult decisions where almost the market has to exclude and then write back? Well, we're not there yet, but the only problem with this, of course, is that AI is so embedded already in everything that anyone does. It's just like trying to exclude telephones.
So one of the lessons I feel I've learned, particularly in my time here, was the inelegance that we got to the right situation when it came to cyber war. So the right thing to do is to have a balance of the capital that's needed to take such a difficult and unquantifiable risk to back that product. But I think if you look at it from the lens of the customer, where you've started out saying nothing about it, and then as you build your knowledge, you start excluding or you start making things a little bit different covers, that was a bit inelegant from the perspective of the customers we're trying to serve. So I think we've got to make sure that we think ahead quicker, and rather than think about exclusions, think about how do we include things and how do we communicate in plain English and plain economics, how we're thinking about those risk categories and how they may change over time. So I would like us to be thoughtful in the first instance before we sort of go down the exclusion route or the silent route. Actually think about who we're trying to sell this product to and how do we ensure it has the characteristics that people want. Because we may celebrate cyber, but the take-up is still very, very, very low, particularly from SMEs and from individuals.
Well, I mean, I was looking at a prominent case the other day, and it's amazing, how we've been doing insurance for 300 years here, and you can still have claims about whether it's one event or two, one limit or two. Is this actually covered or not?
Yeah.
I think we've probably got to do better on that.
I think for years we've wanted insurance to be in the financial mainstream and in the media mainstream. It now is because of risk characteristics and the events of the last few years. We've got to make sure that our market keeps up with its newfound position in discussions in boardrooms, in halls of power, and in the media. And so when it comes to the language we use and the constructs we use for those policy, we need to make sure it is understandable and it is reasonable for an average person on the street to sort of be able to pick up and go, yeah, I understand why they're doing that. I understand how the pricing changes. I understand the terms and conditions. I understand they've got to change as circumstances change.
It's almost the eternal challenge. I'm going to have to talk about something much more mundane. Obviously, it's part of the strategy was retirement of Blueprint 2. Well, one, what remains? And I suppose the most important thing is sort of what is the assessment of what tech we actually need? And then I suppose that's the most important thing, isn't it?
Yeah, I'm glad you're finding Blueprint 2 mundane.
Yes, you're in charge of it, so ultimately it might keep you up at night, whereas the rest of us have to just observe. And I've been observing for so long that I was a broker, through the 90s, EPS, the Connect situation, and then G6, then Market Central Services Refresh, Tom. I've sort of got a collection of different badges and things.
I hear you. I mean, I think from my perspective, the weight of responsibility to ensure this market is invulnerable to predictable risk is enormous. And that feeds into my thinking about the operational resilience.
I mean, it's the sort of thing that the PRA would be all over you on. If the market shut down because something had broken somewhere, it was written some code that was helpful for the moon landings, but no one else knows how to rewrite it, then I suppose that is a serious problem.
Quite, but it's not just the PRA, it's the CEOs of the businesses I see all the time, but from an underwriting perspective who've put their people and their capital here, the brokers, the clients, we've got to make sure that we can serve the market. So operational resilience is absolutely critical. So when I became CEO in the summer, the first thing I did was begin a review just to make sure, have we got operational resilience as our core driver for every decision we're making. Once we put that in place, then we can decide about, is it right to have the ambition that was there with Blueprint 2, and is it going to be worth the slog in order to get to where we're going to get to? We had a look and we de-risked the program first, and what we talked about a few weeks ago was, it was my judgment that we had learned the lessons, we had operational resilience where we wanted it, and we were going to therefore sunset the more lofty ambitions, which, to be honest, had, in some cases, we'd reached the conclusion they weren't deliverable. In other cases, they were actually becoming a little bit outdated for what's coming in the market and what the demand is coming. So we very much pivoted to operational resilience, number one, and actually meet the market where they are going, number two. which is ensuring that we have the flexible open architecture that can connect into the APIs that are being built in the systems of the businesses that we serve. And so we won't dictate from the center that everybody's got to do it a certain way. We'll treat operations, tech, and data in the same way as we treat underwriting. People are going to do it in different ways. People are going to compete or invest in different ways. And we've got to accommodate them all in this market.
Yes, but you're dictating the end results. You're not making a 12% return over the cycle, but I don't know how you measure the return on IT investment or on efficiency in that sense.
But the business models are going to be very different. A business model like Key is likely to have more reliance and more investment in data technology systems versus an emerging specialty reinsurer that is going to write less risks and will have a different way of bringing its data in, maybe using, I don't know, AI or whatever. So I think it is a danger when the corporation dictates that everybody has to have the same operational business model.
Yeah, but it works sometimes. There's always that balance in between letting people work out, knowing that they probably know the best way of running their business and they can work it out for themselves, and allowing that competition as well rather than monopolizing something. And then occasionally just saying, you know what, mandate. It is good to mandate. I mean, and that situation where we'd had the Connect hadn't worked and then we move to the peer-to-peer idea of G6, which is perhaps, if you were looking as a cynic, it's another way of saying not really doing anything, and certainly not doing anything centrally that could be responsible for. But at the same time, there was mandation of using electronic claims file, because there was absolutely no reason for people to drive paper slips down to Chatham anymore, because even if it was a glorified PDF, it's still electronic and it's way better than what we've had before. So you could mandate that because the technology was so ubiquitous at that stage. Everyone knew what a PDF was, and you have a slightly glorified PDF with all the details of a claim on it. It's way better than just a piece of paper. So you could mandate it.
So I would equate what you've just described in the PDFs as where Sheila Cameron and the Data Council are going on certain data standards.
Do you think we could be mandating some of those standards there?
Luckily, Mark, I listened to your podcast, and you recently had one of my council members there for bosses on. So I'm in the same place as Sean is. You don't mandate from the get-go when you don't understand what everybody's doing in their own businesses. You mandate to bring the stragglers along, where it is, using your terminology, where it is virtually ubiquitous
it's
already.
Absolutely beyond the pale not to use this.
Correct. So we've got to make sure that when we're talking about mandates, they're done to ensure that we don't have the tail wagging the dog, but we have got a very clear strategy when it comes to tech and data that is of the market, for the market, developed with the market on the data councils, and we are able to accommodate different business models, but we keep to those core standards that allow us to be efficient.
Yeah. In terms of the expense ratio at this time of the cycle, obviously some parts of the expense ratio right now are well-earned bonuses from profit commissions and all the good things, the fruits of people's labour, of their excellent, skillful underwriting. But at the same time, there's always a point in the cycle where you think, goodness me, expense ratios starting to creep up. Can I do anything about it?
So I come at this from two angles. If there's any unnecessary expense that's being driven into the businesses who are working at Lloyd's because of Lloydsisms or the corporation being either thoughtless or careless about how we are operating, that is the low-hanging fruit that we've got to go after. And that is that efficiency point. That's why it's our number 2 strategic driver. But when it comes to having an absolute number where we say we think expenses over X% in a business is too much, that again has us wandering into people's business models carelessly. So it might be that one business is operating a certain way. It has slightly higher commissions because of the way it's picking up business, or slightly higher operating costs because it's investing in tech and data. What we look at is the underlying combined ratio. So what is underlying in the business? And therefore, at this point, while we can accommodate very different expense ratios in different businesses, my actual concern is the creep in the underlying combined ratio in 2026.
Of course, if you spend 2 points on extra expense, you might get 3 points saved on the loss ratio, and you can demonstrate that. Fine. I think it was clearly money well spent.
Yeah, but at a market level, so we've gone from a 79.1% underlying combined ratio in 2024 to 81.8%. So quickly, that's 13.2% away from that 95 combined ratio that we've got to protect. So is 13.2% enough margin to allow us to absorb the unknown, the major claims and CAT, or further erosion of the margin by lower rate, by higher expense, or by lower releases in the prior years. I think 13.2% is getting close. So even though the long-term average, so the 10-year average in large loss and cat for the market is at about 10%, a few years ago it was at 13.8%. It's because we've had 3 lower years. So what we must do at the corporation is ensure that we are stripping back anything that is presenting us a maybe a rosier picture than is really the case over a sustainable period. So what Rachel Turk and her team are doing at the moment is just looking at all of the adequacies across all the lines of business and looking what margin there is to give up. So I think when you see Rachel stand up in Market Messages in May, you're going to hear some pretty hard-hitting messages that say, we are talking about the speed of moderation of rate. The speed of moderation of rate at 1.4 was slightly bewildering. So are we as a market bringing the difficulties of 2028 into 2027?
Yeah.
Rather than looking at an individual expense ratio in a firm, at a market level, we're at the point where we really need to start
focusing. Is it just
focusing.
we're more efficient?
No, it's not.
If we go, we were a very competitive market, we had some excess margin there, and then we've competed that away quicker than everyone thought we would. Obviously, most of the market has also been surprised that rate has been competed away quicker than they thought it was going to happen.
Let's be honest, I think there's an abundance of capital in the market that's been generated both from retained earnings and new interest in the market. And I think the responsible businesses will make the responsible decisions to either give it back to their shareholders or find genuine new growth.
I suppose now also we know where the bone is. We know when we need to stop quicker, don't we? Before, we didn't really know where we were. 30 years ago, we weren't as skillful underwriters as we are today. Obviously, the world's changing all the time. The price changes all the time. The real loss cost changes all the time. But we are better at approximating to it these days. And so do you think you have every confidence that most underwriters will know when that margin's gone and it's just not there anymore and they have to stop pushing?
Yes, that is the case now. And I think that we have under principle-based oversight when we're actually able to spend a bit more time understanding the businesses. I think we do have confidence, and we've seen folks pull back. I think what the market expects us to do is to make sure that we play our role in understanding what new businesses can come into the market. Now, we've got a duty to ensure that we run a competitive market here, but we also have a duty to ensure the market is sustainably profitable. And so while businesses around Lloyd's and beyond will be judging the right time to stay, to take the rate adequacy that might be in a line or pull away, as Lloyd's, as a corporation, what we've got to get right is to find the right balance that growth in the market is sustainable or becomes unsustainable. That's the challenge.
Yes. Back on the expenses, brokers' margins, obviously I was a broker many years ago and average margin of the broker was probably 15, mid-teens, and then sort of the phenomenon of the global broker came into being, and then I think there was a huge amount of work went into making those brokers become far better run than they ever were. They were almost a collection of almost lifestyle businesses, perhaps in the late 80s, early 90s. And fine for that, but now these are large global corporations, extremely well run, but now with margins in the 30s or top 20s now. What's your strategy, particularly around the brokers? But do you think there should be more competition among brokers? I mean, I don't want to get you in any trouble. Obviously, this is a 100% broker market.
So I'm in the comfortable place of not being responsible for the oversight of brokers, which is great. So I think what we got to make sure that we're allowing the Lloyd's market to do is to be relevant to the brokers in the direction they want to go. There's been a huge amount of discussion about broker facilities and portfolio solutions. Actually, Lloyd's as a marketplace, because of its syndication and because of its ability to match first-party and third-party capital with risk, is actually a good place for brokers to find solutions for their clients. And I think you're seeing some really innovative solutions put in place by some of the wholesale brokers matching third-party capital, institutional capital in Lloyd's. I think that, like every business, brokers will be a victim of their own success. If you're providing that level of growth and that level of margin, that's what your investors expect you to continue. I think we've got to make sure that we understand the direction they're going, make sure that we continue our relevance, and if they want to find a path that is more efficient to the risk takers here, we'll make sure we enable it.
So it doesn't sound like you think that those margins at those levels are unsustainable.
I don't think it's for me to say. I mean, I think we run a healthy market. I think there's a neat tension between the folks in the market. You've got to decide what the rate of return on capital that you want for your business is, and then decide how to trade appropriately. We don't have a universal rate of return that everybody's shooting for within Lloyd's or within the wider insurance market. So I think you've got to have your relevance, your reliability to who you serve. The trend I would see that I think is common to brokers and underwriters and insurance businesses is a desire to get paid for the origination, the investment in the origination that you create. So if you do own the client, if you've invested in winning the business, either as an insurer or a broker, you want to have a more, I would say, directional role in finding an ultimate solution for it. I think we've seen it on those portfolio solutions. I also think we've interestingly seen it on some of the reinsurance solutions, where you've seen in Lloyd's firms like AIG or Allianz actually finding a syndicate solution to part of their reinsurance placement. I see that as being in control of your origination, being paid for your origination.
Yeah, and I suppose in the end, if you add the value, it's very plainly clear who's adding the value and who gets paid. And if they're not, then the competition hopefully would come in and take that away from those who are undeservedly being paid for things they're not doing.
Yeah, I think it's increasingly clear. And I think the common trend that we see, and you see it in both in personal lines and commercial lines, you see it over time, that as a business becomes better understood, as the data becomes better, it becomes commoditizable to some degree or another. And that's when you've got to make sure that you are being very tight in any value leakage. And that's where I think you see more structuring, when the business is becoming more reliable in terms of its risk characteristics.
Yeah, and another one of the factors, obviously, if brokers innovating, doing things better, becoming way more efficient, has been this facilitization of most of their portfolios. Obviously, this is something where you really can add value by recognizing your portfolio and offering shares of that portfolio. And often now we're seeing some of those with an inbuilt client discount, which can only be a good thing, one presumes. How comfortable are you with that development? Because it's really accelerated and it only looks like it's going to continue to accelerate. And I suppose, how far of a share of the market do you think it would take before you start to become uncomfortable?
I'll answer your last question first.
Yeah.
What point do we become squeamish about the percentage?
Yeah, we're cannibalizing ourselves.
Again, we go back to our principle-based oversight approach, that if within our risk frameworks we're seeing a level of capability and a level of indexation, so a penetration on a cross-class basis of a broker's portfolio, if you're seeing that in the underwriting that's being done by the underwriters who are taking a share of those facilities, then I don't have a binary number that I've got in place that says it's 10% or it's 5%. It's about the capability and it's about the controls, both from an underwriting and a risk perspective, that are in place. When it comes to, do I think these become more dominant in the market? There's two very different types of facilities, right? There's the facilities that are non-cross class, that are sort of just widely distributed, whether it's a terrorism facility or a D&O facility. They are what they are, and we don't have a huge role in those. They're usually Lloyd's and non-Lloyd's, so people are big enough and bold enough to compete on those themselves. We look at that from less from a facility perspective, just more from a control of your delegated book perspective. When it comes to those cross-class facilities, we do have the view that they must be Lloyd's only, so we are able to ensure that there's an alignment of purpose, that you don't have somebody on the facility that's just there to grow their business, to sort of pump and dump, so to speak, to sort of grow their top line in order to do an IPO in a few years' time. They've got to be within our underwriting philosophy here, that 95% and that return, etc. So we do think that Lloyd's only facilities are the right way to go when it comes to those cross-class. We also believe that you should only be able to be on those facilities if you've got the capability to underwrite them for yourself. We don't believe in blind following in those facilities. You must be able to have the capability to process the data and to challenge the broker to make sure that you have that ability to maintain profitability.
So you're still underwriting?
Yes. But we also have to acknowledge, and the brokers are always quick to remind me of this, that they have options. So you've got to provide a great service to the brokers. They can take these somewhere else. There's plenty of people willing to write this business. Our data would show that these facilities most often and regularly outperform what is the total market if you can get the cost within the total trade right. So it's Callum Alexander who runs this for Rachel Turk here. We built a team on our delegated side that's much more focused on performance of the delegated book rather than the admin. And I think we feel in pretty comfortable shape.
And I suppose if they're generally mirroring the performance of that class of business as a whole, and they're nicely indexed and there's not weird things happening, I suppose then you're happier when that's happening.
Yeah, but I think if I was sitting here beside some of the leading brokers, they'd say, well, we expect our book to be better than the market and better than the wider index of a class of business because we've got better pick of the clients, we do our own underwriting, so to speak, of the risks that are coming in. And actually, if you look at some of the much more seasoned facilities that have been here for a long time, I mean, the one that always comes to mind is that Bowring Marsh facility from way back when. It's a megastar when it comes to performance.
But you're not worried at all in terms of that ability to lead being lost if you just had a leader and then everything else was physicized, there were no alternative leads sort of being nurtured or being able to participate?
I'm worried about everything, but I am worried about that. But I think the idea that we ban our way to progress or we regulate our way back to the way we want the world to be is not the way forward. We just need to make sure that we're ensuring that we're growing the front of the business to ensure that we are bringing in leaders of the future. We are bringing in the likes of Cathal Carr and his team at Oak, that you're having new leaders come in new areas of business such that we are replenishing the leaders for the future. Because you're right, that if everybody just becomes a follower, that's not a good thing. If everything just gets facilitized, then there's less.
And in the end, it becomes less competitive and it becomes a bit unwieldy, and if you're the only person who wields this massive $3 billion sort of aviation line and everyone else follows you, at some point another broker's going to say, you know what, I think we need an alternative facility to this one because this is becoming a bit unwieldy.
For sure. But I think the other thing I would say is that we focus on the broker side of this quite a bit. I agree with you that maintaining lead capability in this market is critical. We do it from ensuring that we don't shy away from nascent risks. I also think that there's business models that have been here for years that are going to come under strain, that as third-party capital finds a way to connect with the leading underwriters through just being a corporate member on a syndicate, they don't add 10, 15 points of expense. So if your business is just to follow, if you don't have lead capability in your syndicate, I think that is a business model that's going to come under significant strain.
It's what you've said about those facilities. You want those people to be still underwriting those facilities properly and capable of underwriting and processing all the information that goes into those facilities. Obviously, as you broaden the capital base, and it's been a great success, the London Bridge 2, and I want to ask you whether you have any particular ambition for it, or maybe you were just more laissez-faire about it will get to whatever size it's going to get to. But for capital allocators, where they're almost one step removed from underwriting. They're underwriting at a very broad portfolio sense of saying, I want exposure to insurance at these kind of rates of return and this kind of risk. But are they really underwriting? One, are you comfortable with having sort of pure capital allocators coming through these new conduits? I suppose you still have to regulate them. You still have to make sure that they know what they're doing.
So if you're a pure capital allocator, the smartest way to connect to risk in the Lloyd's market is by being a corporate member.
Yeah.
You don't need to have all of the cost and requirements of a managing agent or a syndicate. So I would say that is the smart way to do it.
You still need to get approval to know what you're doing. Yeah.
Yes, but you still need syndicates to back. So making sure that you back the right syndicates that have that underwriting nous is critically important. I think in terms of what's next for London Bridge 2, London Bridge 2 has been extremely successful. I mean, I think it is one of the great legacies of the future at Lloyd's, and Burkhardt and his team should be very, very proud of what they built. And it is growing. It's growing quickly, and it is allowing us to be an international market for capital as well as for risk. However, we are seeing the demand demonstrates areas where we've got to meet those capital allocators on their terms. Maybe a bit techie here, Mark, but London Bridge 2 allows equity to find its way to back risk in Lloyd's. We're now having folks talking to us about, can we have a debt vehicle? So debt can also be used to find its way through the London Bridge vehicles. So will London Bridge 3 be a debt equivalent of the equity that's in London Bridge 2? Let's see. It's a great concept for a couple of reasons, because it does democratize and it opens a route for international investors, international finance into the London market. And I think the Treasury deserve a huge amount of credit for working with us for those permissions. But I think it also allows us to think about structuring in a whole new way. It allows us to think about insurance being a much bigger part of the early part of structuring of infrastructure, investment, etc. going forward. I'm going to make sure I make the comment that in the excitement about London Bridge 2 or 3, etc., and institutional capital finding its way. I've got to be honest, I'm really proud of the success over the last couple of years, not because I don't think to do it, but just because I'm sort of sitting here watching it, of the reinvigoration of the individual names, and they're finding new ways to connect with Convex, with Fidelis, with Oak, and using that modified freehold capital. We sometimes beat ourselves up about not being innovative because we don't see it in a product. But I think we're seeing great innovation in capital. You've heard me talk about this before. As we go forward, it's the total innovation that using all of the innovative characteristics of this market, capital, product, service, underwriting, that is what's going to make this a really exciting market to be part of. That's what's going to allow us to meet the challenge of the generation that we're in because of the scale and the complexity, the interconnectedness. And that's what makes me pretty excited about the next few years.
Yeah, I had a sort of wild dream about what London Bridge 2 could be one day. Could it be a sort of, we wake up and there's sort of BlackRock Lloyd's number 1, Vantage Lloyd's number 3. These could be huge pots of capital. They're quite small for BlackRock, or small for the Advantage funds. The sort of thing that anyone could invest in and say, well, these are the main buckets of capital that Lloyd's dips into.
You've given me a perfect way to segue back to my core strategic drivers. So the reason that we put financial returns at the core of the strategy, that 12% return, that underwriting core at 95%, is that it provides transparency, predictability, and therefore investability for those who want to come here.
I'm not going crazy if I thought that could be possible at some 20 years' time.
It is well within the bounds of possibilities. So how I think about the challenge I'd like to give boards, CEOs, investors in the future, it's to be asking themselves, why not Lloyd's? Lloyd's has an inbuilt capital advantage of 33% if you can isolate and structure the capital correctly. So why wouldn't we do it? So let's say there's a business today of $2, $3, $4 billion that has over the years needed to be Lloyd's plus Bermuda, Lloyd's plus non-admitted in the US, Lloyd's plus a European platform, because they couldn't get what they wanted from Lloyd's, either from a service perspective, from a cost perspective, or we were a little bit unpredictable in our decision making in terms of how they wanted to grow their business. I would love in 4 years' time, they're sitting around the board table and their board is saying, hang on a second, you can do all that in Lloyd's, and if you do it all in Lloyd's together,
it's way more efficient.
You get the capital efficiency. So why are we not doing it? So that would be a great problem for me to be giving the CEOs who I feel have given me marching orders to get on with making decisions with finance and financial returns at the heart.
There's lots of lovely, quirky things about Lloyd's and curiosities about Lloyd's. One of them is the turnkey system. Now, in nearly £60 billion GWP market, do you ever feel that is something that should evolve or be updated in any sense? Because it's almost as if you're outsourcing your own startup function to somebody else and you're dependent on them bringing those opportunities.
Yes, so I think the major turnkey providers do a great job here because they do allow the ability of entrepreneurs and small businesses to scale in a way that they ordinarily wouldn't be able to do. So the turnkey providers are a critical part. However, we're finding businesses that are reaching scale pretty quickly. In the past, it's been frustrating to be able to make the transition from being within a turnkey provider to being your own managing agent and having your own syndicate. I think folks like Ashpathia, who I'm sure we've both talked to quite a bit about this, who've made the jump across, will have said, well, it was quite long, quite arduous, and quite costly. One of the things that I'm pretty happy that we've found a great accommodation on is the work we're doing with the PRA in particular and the FCA as well. Now that they've got competitiveness as a secondary ambition within their business models, we are working with them and we've said we've got to have more speed. We want syndicates to be created at this speed and we want managing agents to be not created over 9 months. We want to be as quick as Bermuda, as quick as Singapore. We want to be there an awful lot quicker. And so we've run pilots with 1 or 2 firms who've actually come through and will be launching their own managing agents this year. So I think if you can come to Lloyd's and say, I want to get started pretty quickly, if I can either scale out of the gate or if I know I'm going to reach scale within year 2, 3, I know that there's a route to having my own managing agency, my own business at a reasonable cost over a reasonable time period. That's great. Syndicates should be up and running through our process if you're ready within about 6 weeks. If you're an existing managing agent, maybe 12 weeks if you're not. And then I want managing agents to be able to be created within 6 months.
So basically nothing really needs to change, you'd say. It's all really about the speed and that's more a regulatory question from the higher ups.
It's actually Lloyd's, the PRA and the FCA working collaboratively in our joint interests to make the UK and London a fantastic place to do business.
Yeah. Do you think there would be a situation where there are exceptions? We've had the odd exception of occasionally sort of being grandfathered into Lloyd's without having to go through a turnkey. It happened very, very occasionally. Do you think we could evolve to a situation where if you've come completely tooled up, particularly if you're talking about a very large entity, that might be able to happen? If they've got all the expertise, they've got boards and they've got people with all the experts, everything they need.
I think that allows an acceleration, but I think there is the requirement of getting permissions that is just actually part of legislation. So you can't just jump that. I think what the regulators in the UK have been great at doing is embracing what we've done on principle-based oversight, which allows us to not have to say, let's tick 781 boxes. Let's actually look at the capability of a large group coming in, and actually we can have a presumption that they can meet this level. So I think we're working very well with the UK regulators on that, but we've got to continue. And we're building a mutual trust. And Lloyd's has got to demonstrate a track record of nailing this time and time again.
On the strategy, did we talk specifically about brokers? Is there anything specific there? When you're talking about brokers, what you're really saying is, as long as you give them all the service, that's that. Or do you have anything beyond that in terms of a strategy for brokers, particularly of the way you engage with brokers?
So I think in terms of our stakeholder management and our relationship management of brokers, it is critical to make sure that we are listening both to the global brokers, but also to Chris Croft and the brokers at Liba, who maybe don't have the louder, more international voice, that we're continuing to serve the specialty business, the fantastic business that they bring here. In terms of what we have announced in the strategy that's for brokers, number one, make sure you've got the risk takers here to be able to underwrite the business that their clients are bringing. Number two, as you rightly say, make sure the service and the speed of service is there, both from the corporation and allowing the syndicates and managing agents to have the speed that they want to have. I'll go back to something that I said a little bit earlier. I think it's really important that we allow the ambition of the market in terms of new risk to be able to be the place where brokers of all sizes and of all shapes know that in their muscle memory it's presumptive that if they're going to do something that's pretty novel, that needs a bit of structure, that's pretty new, nascent risk, Lloyd's is probably the place to come.
One last question. We've had, obviously, lots of discussion around culture, and part of that being non-financial misconduct.
Yeah.
Is that now an issue that is sort of has been settled effectively, or should we expect to see more? Because, we were stories probably about a year ago of consultations and things happening, but I haven't seen necessarily any result of that yet. Should we expect to see the definitive work on that coming out, or are we kind of done on this topic?
Two things. I'd say we will never be done on the topic of culture. I know it's trite to say it, but it is what I think of in the morning when I wake up and the last thing before you go to bed. What have we done to ensure that we are enriching the culture of the place, that we're attracting and retaining the talent, and that you can look yourself in the mirror and say, this is a great place to welcome people to work in. So it is constantly on my mind, the topic of culture, behaviors, value in the market. It's constantly what we're talking about in the corporation. I think the oversight of culture, so the regulation of behavior in the market, which is what you're talking about in the non-financial misconduct. We did the consultation, and within the consultation there was a strong steer to, can we wait as a market to see that what the regulators in the UK, what the FCA come out as their interpretation of non-financial misconduct. So we did wait, and so there is the last act that we need to put in place is to ensure that we have good alignment between the regulatory framework for financial misconduct from the FCA and the market here. So that's the last thing we've got to do from a regulatory perspective. But in terms of the culture of the place, every day, it'll always be a critical topic for us.
Absolutely. I suppose we all know what good culture is. When we see it and experience it every day.
Yeah, it's why we put at the centre of the strategy a Lloyd's to be proud of. It's not dictating what good looks like. It's making sure that everybody can be rightly proud of the market that we share together. It's not just the market for the society or the corporation or the people who are in the room with us here today. Our reputation is critical in how we trade and how Lloyd's is perceived everywhere around the globe that we trade, or whatever it is, the 200 countries that we're present in. That brand, that reputation, critical to us. And so we've got to nurture it and curate it very carefully.
One last question was, it's going back to the Blueprint 2 in terms of leaving some of those lofty goals. Just to press you on, so I'm inferring here that you are comfortable. We're not going to get a situation where the accounts will not be settled, where the cash machines effectively won't work, that the core systems are
very
fine, that
very
they're fine.
Comfortable. Yeah.
Good.
And not fine for a week or a day, fine on a 5-year rolling period.
That work has been done, and the backbone's been sort of replaced to the extent that it's fine. The rails are running.
And the relationship that we have with Velonetic and with DXC, who are the delivery partner there, is very strong. We know that we succeed together on this, and so we invest deeply in it. Stefan Flake, who came in as the COO of the corporation, has had a fantastic impact since his time here. And I think you're all now focused on common goals, and the operational resilience is at the heart of that. And because we want to ensure that we have 5 years of operational reliance in front of us as we build for the technology and data strategies of the businesses here for the future.
Patrick, thank you so much for being incredibly patient with me, and you might be able to hear it's got very quiet because everyone went to lunch, apart from us.
I'm actually starving, so looking forward to a bowl of soup now.
Thank you so much.
Thanks, Mark. Pleasure.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this programme. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.